Cycles are an interesting phenomena, and they're much more complex than most people think. And there are a much greater variety than most people are knowledgeable about. And I just wanted to comment a little bit about cycles. Most of you are aware that the day trading Visual Basics system is built on reversal recognition. And reversal recognition is basically cycle tops and cycle bottoms. We decided that the system had to have the ability to identify strength of a movement. That was one of our goals when I first started the system, and keep in mind I was doing it for myself. I was having really bad inconsistency problems in my trading, and I needed to be confident in what I was doing, and in order to do that I needed to see what I was doing. And in order to see what I was doing, I needed to create sensitive indicators. And through that whole process of keeping our eyes on specific goals that we needed to accomplish, that the system would have incorporated into itself, we eventually came across some key elements, and those are primarily indicator line lengths. The line lengths identify the strength of a market or the strength of a push within a stock. The classic example is a BOC pattern. That's a V pattern with the left leg starting as a start, and that left leg is, let's say, 2 points long. And when the right leg closes, it ends up being 3 points long. So the right leg of the BOC pattern is higher, and that's a BOC higher pattern versus a BOC lower pattern. And the higher pattern obviously generates more strength. When you have a cycle, the BOC pattern is what starts the turnaround of the bottom cycle. The indicator line that you look at is critical in making that in identifying that cycle. The fast lines like the trend red and the power red and the swing Zion, those are the big three. And others like swing pink and zip red and gray. Those quickly tell us about the immediate change that takes place within the cycle. Divergence has its has its place in cycles. When you have one line going up and another line going down, you have two market forces pushing against one another. And these indicator lines are the first to recognize that. Obviously, if there was not, the indicator lines would all go in the same direction. So the cycles, the key cycles that we're looking for, obviously, are the ones that have strong movement. For example, when you have a TOC pattern, you can have a TOC higher or a TOC lower. In a TOC pattern, the indicator goes up and then it goes down. And when the right leg is farther down than the left leg, you have a TOC lower pattern. But when you have a TOC lower pattern at the bottom of a cycle where you should have a BOC pattern, The TOC lower pattern is an example of a strong push in pressure, usually in price as well, identifying that it typically has pushed itself, the price has pushed itself too far down. Now this is obviously done by individuals, be it floor traders or just the natural flow of equilibrium in trading. But when it is also, when a TOC pattern is lower and it's at the bottom of a cycle, it is also divergent because it's appearing there when it's not normal for it to appear there. And so that divergent condition causes a reaction reversal back up. And then you get that BOC pattern, the start of the uptrend. So we can see forces before the turnaround and after the turnaround. And these are the ones that we look for. So obviously you want to look in the fast lines. The swing gray is our deep cycle indicator. It's the best one that we've created. The other deep cycle indicator is pink, power pink and power blue are paired together, and either one can be lower or highest, but normally it's pink. The pink, power pink is a deep cycle indicator, but we call it a short cycle indicator. It picks up those quick movements. It's not as quick as your 22 market force indicator lines. Some of the fast ones, I guess I should say. But it will identify cycles, low and high cycles. The cycle or the goal of creating a system that could identify the strength of a movement has been completed in that cycle, in that process of identifying indicator line length. In a swing gray, for example, that the deep cycle indicator, it's a slower moving line. It doesn't change like a power pink can pick up a short rallies when swing gray is going down, and swing gray will maybe flatten out a little bit, but it won't stop from going down if in fact there is more down push to it, because it picks up more information or something that is totally different from the short cycle of the power pink indicator line. So what I'm conveying here is you can watch slow moving lines. Obviously the swing gray will eventually turn into a BOC pattern and start going back up, and that's the real bottom of the cycle. It makes a difference in which indicator line you watch to determine your pullbacks and your rallies, and those are obviously your fast moving lines. They're on the master platform chart, they're drawn in as narrower lines than the other wide lines. The 7 short-term trend lines, that's the 3 trend trio lines, yellow, pink, blue, the power orange and green, and the swing red and green. Those are your 3 groups of your short-term trend lines. Those are also wide lines. They move slower, but they have power behind them. And so when we're looking to go into a long move, it can be, it is advantageous to always look at the 7 short-term trend lines to see which direction they are going. Obviously, when you have gaps, they're typically, not always, but oftentimes going down, and you gap up, and then they do a BOC themselves. But the issue is the strength. And we want to, when we have a BOC pattern that is a BOC higher pattern, that oftentimes can lead into multiple days up or an uptrend. And so we can spot a strong uptrend on the first day that it starts. This is power. This is knowledge. This is information that others don't have. And it's all based on the sensitive indicators. The cycle that we have, or that we change into, and who recognizes that cycle change first, are the ones that can obviously benefit the most. Because if you spot a cycle change and you can get into a position, you can just sit and watch as everybody else is buying into the position and driving the price up. So the point that you enter a position is critical. And being early is obviously much better than being late. Now, cycles also have a variety of situations, or let me say this. You can have a particular gap up that occurred with defined terms in a particular stock. And 2 weeks later or 2 months later, that exact same pattern will appear in that same stock. It's a cycle repeat. It may not appear for a year or 6 months or a long time. What I'm saying is the same identical pattern that created the 2 gaps up. Now, in other situations, you can have a identical pattern that it will occur. You can have let's just talk about a gap up pattern. You can have a gap up pattern with a defined set of indicators. Keep in mind, for gaps up and gaps down, you have to have 3 pattern groups. There are 20 patterns, over 20 patterns in the pattern types up, and over 20 patterns in the pattern types down. 3 of those in the pattern types up are the identical indicators, the down touches in the trend chart, and the proximity group patterns. This would be the Power 4, pink, blue, white, and yellow, along with Power Zion, which makes it the Power 5. And the Power 5, or the proximity group patterns, are based on shapes, which are basically identical to the shapes in the 22 market force recognition indicators, because keep in mind they are the 22 part of the 22 market force indicators. But there are a few nuances that would identify a little bit differences that we keep them separate. But most of them are identical. And then you have the proximity group pattern locations. So when you're identifying a gap, you have to have 12 or more of the identical indicators, either in a 1 or a 2 pattern group. You have to have the down touch in the trend chart. Keep in mind, you can have what's referred to as a sky touch, and that's with no physical line. Trend red is above trend green, and it's been there for 1 or 2 or 3 days, sometimes 4 days. Heart never appears after, we don't deal with gaps after that. But normally it's 2 or 3 sometimes, and it happens frequently in 1 day. And basically, when I say 1 day, I mean that the red crosses over the green. So you have the crossover day, and then you have the next 1 day later, or you have 2 days later, or 3 days later. You hardly ever get into 4 days later and get a gap. But that is, with red above green, that's a basic definition of an uptrend. As red travels above green, you're in an uptrend. As trend red travels under green, you're in a downtrend. So that's referred to as a sky touch. You have to have one touch in the trend chart in order for a gap to occur. As long as I'm on this subject, I'll quickly comment about the position, the lines that you can touch. Trend green, red, and gray are the lines that down touch or up touch the other three lines, the trio, yellow, pink, blue, the wide lines. The three fast lines, red, green, and gray, also down touch 0, and they also down touch under 0. So there are 5 down touch lines that qualify for a gap up, and with the sky touch, there's really 6. And so, because those will gap up. When you have, again, the identical indicators, the gap down, and the proximity group power 4 or power 5 locations, and shapes that go along with it. The locations are more important than the shapes, because you can get scattered. You can get a couple lines above power orange. Remember, power orange in your power chart is the dividing line, your divergence line. When Zion is under power orange and the power 4 are above power orange, that's a condition for a gap up. It doesn't mean that it's going to be a gap up just looking at that by itself, because that's there a lot. You need the other 3, you need all 3 of those conditions, all 3 of the proper conditions in those 3 pattern groups to identify a gap, either up or down. Now, particularly I'm referring to gaps up, because gaps down have more variety in their supporting evidence that we don't see as much in the form of, I mean, we still see it, but not to the degree that we see the pattern locations in gaps down. Now, the cycles that we think of in the relationship to the indicator activity and the identification of those turnarounds, either be it a bottom cycle or a top cycle, are conveyed in strength. And by the strength can be the indicator line length, or it can be just a multiple amount of data as supporting evidence supporting our change, our gap up or our gap down. You couldn't have another complete pattern like zip Zion is lowest, and that's a supporting evidence for the main pattern that you've got showing the gap up. You can just have indicator line lengths. You can have price lines way above blue. They're real high, and they go up. There's many types of supporting evidence. The cycles that go along with this change repeatedly, and there's a variety of types of cycles that I'm talking about. You can have the cycles that we typically think of a bottom cycle or a top cycle. We don't necessarily recognize that a particular stock will cycle up really strong or cycle down really strong. We see patterns in cycles. A stock may have a price range for several months of 25 cents, just up and down, and a few scattered, double that. And then it can go into a month of 50 or 75 cent range movements, high to low movements. And so that cycle, people don't think about how things cycle through, or they don't think of that, about that type of a cycle. And it's important to identify, it's important to think about the different cycles that we see. So this obviously isn't complete or total, there's much more to cycles than what I'm conveying here, but I just wanted to give you a brief opportunity to just think about cycle movements, because the system we have is based on this reversal recognition. We identify those stocks that are moving strongly. Those are the ones that we want to trade. If you've got a BOC lower pattern, what it means is that the stock is now, the sensitive indicator has identified that the stock is going to go up, but it's a slow movement, or it's a weak movement, because you got a BOC lower pattern. Now that doesn't mean that the next day it might not be a big green candle, but what and sometimes that does happen, because the cycle starts its big move on the first day or the second day, and then after that it can either continue, or depending on the candle length, it can turn. If you have a weak cycle if you have a BOC lower pattern, the candle doesn't move much on the first day, and on the second day it doesn't move much, then typically you've got a weak cycle, and you're better off looking for something else. Unless you found something that you just want to do a swing trade in, and you're planning on hanging on to it for 5-10 days. But the strength of the turnaround, and obviously gaps are the epitome of that. We like to find gaps, but you can find all the information that supports a gap, and then it will end up into a 5-day uptrend. And this happens more often than you think or don't think. But when you see the three patterns, the identical indicators, the down touches, and the proximity group location patterns, without any supporting evidence, or with maybe only one little line on a different chart, then that can be a uptrend. I mean, it can be a gap as well, but it's an analysis of indicator line length in multiple indicators. It's just like the down touch. The vast majority, excuse me, the vast majority of down touches occur in the trend chart. I'm going to say 75 to 85% occur in the trend chart. Down touches and up touches occur in all of the subcharts, but in order for it to qualify for a gap, we need to have something in the trend chart, because that's the most powerful. And we've learned that, if you have 21 indicators in the same pattern, that's great, but it doesn't mean you're going to get a gap. And if you have a triple down touch, red down touches the zero line, and green down touches the blue line, or yellow line, and the gray down touches something else. So you have all three of the fast lines down touching one of the other lines. You can usually get a medium-sized candle out of that without any other information. But when you add to it identical indicators, and you add to it the proximity group in the right location, Keep in mind your proximity group locations, there's probably about a dozen different locations, because Zion can be under power orange and the power 4 can be above. Yellow separates itself from white because the yellow twins, zip yellow and power yellow, when they run together, lowest and highest. When they're lowest and going up, you have an uptrend. When both of them are highest and going down, you have a downtrend. And those patterns will continue even when one of them disappears under some indicator lines, but you need to watch it more closely at that point. Now, with that, with yellow being separate, you have patterns like yellow is under Zion and the power 3 are above, yellow is under power orange and the power 3, that would be the pink, the white, and the blue. Pink, blue, white is the power 3. And so those are above power orange. And that's another type of one of the 12 or so patterns that the location patterns that we talk about. So those, everything is intertwined in this thing. And I think I've talked more about the patterns themselves than about cycles, but you can't understand the cycles without understanding the other things that move it. So cycles do vary a lot, and you need to watch what those cycles are doing. The trend trio, blue, pink, yellow, they move faster than the other two groups. I've said that on other videos, and it's important. Because when the trend trio is above 0 and the other 4 lines are under 0, you're more than likely heading into an uptrend. And that's several days in advance, or could be several days in advance from a big price movement. You might have, been running flat for 10 days or bouncing around a little. But then when you see that occur, then there's a good chance that you'll have a big price movement in the next day or the next few days. You just got to watch it each and every day. So different cycles, they not only appear in a top cycle and a bottom cycle, they appear in patterns. The patterns can appear, 1, 2, 3 patterns can appear. 10 or 12 pink-green tops can occur in a 3-month period or a 5-month period, and then they'll literally disappear for 5 months. You won't get another pink-green pattern. So the other thing is you can have one pattern that will appear, it's a gap-up pattern. And oftentimes you'll have a handful of identical gap-up patterns that will be in other stocks. And sometimes they're not even identical. But then other days you can literally have 75 to 100 in identical patterns or almost identical patterns, all gapping up on the same day. So be cognizant of what your surroundings are telling you. Always look at your weekly chart before you trade. You want to know what's going on a higher time frame. It'll help you in your trading significantly. And watch those cycles.